A warm welcome, dear listeners, to a new episode of EquityStory.ai powered by iMaps Capital Markets. My name is Lilith Eva-Cipher, and I am delighted to guide you through today's analysis. Today, we are looking at a company that has been on everyone's lips in recent years, but whose stock has recently gone through a tough time. Sonic Healthcare, a global giant in medical diagnostics. The stock is trading near its 52-week low, a situation that has unsettled many investors. The pandemic-driven boom is over, and the market seems to be punishing the company for it. But is that the whole story? Is this a classic value trap, or is it a rare opportunity to acquire a quality company at a significant discount? To answer this question, I have a very special guest with me in the studio today. Please welcome Charlie Goldstein. Charlie is an AI bot from the investment boutique iMaps Capital Markets. Welcome, Charlie.
Hello, Lilith. Thank you very much for the invitation. It's a pleasure to be here. The topic is indeed very exciting.
Absolutely, Charlie. Before we begin, a brief risk disclaimer.
The following content does not constitute investment advice. Capital investments carry risks. We are discussing the business models of various stocks, and you decide what to do with the information and what to invest in. The host and sponsors assume no liability for the sources used in the program.
Charlie, let's dive right in. Since the beginning of the year, Sonic's share price has dropped by around 17%. The obvious reason is the so-called post-Covid hangover. Can you put the scale of this effect into perspective for our listeners?
With pleasure, Lilith. This effect is the linchpin of the current bear story, and you have to understand it in order to recognize the opportunity. Like the entire industry, Sonic was a massive beneficiary of the pandemic due to the sheer number of COVID-19 tests. This catapulted profits in 2021 and 2022 to unprecedented levels. But as we all knew, these revenues were not sustainable. The numbers are truly dramatic. In fiscal year 2023, COVID-related revenues plummeted by 80%. In fiscal year 2024, there was a further decline of 87%. Naturally, this has led to a massive drop in earnings per share, EPS. Over the past 3 years, it has decreased by an average of 27% per year. On the stock market, where people often only look at the year-over-year change, that's pure poison. The stock is being punished for being compared to an absolute exceptional situation.
That sounds like a brutal normalization. Of course, many investors are now asking themselves, if this growth engine fails, what's left? Does this mean Sonic's growth story is over?
That's the crucial question, and my clear answer is no. Quite the opposite. Anyone who only focuses on the decline of the COVID revenues is missing the essential point. You have to mentally exclude these special revenues and look at the core business. And this core business is not only healthy, it is fundamentally stronger and larger than ever before. Let's look at the facts. Net profit in the 2023 fiscal year was still 685 million Australian dollars, which is 25% higher than the level of the pre-crisis year 2019. And the organic revenue growth in the core business, that is, without any COVID tests, was a solid 5% in the 2025 fiscal year. That is the true face of Sonic Healthcare. The foundation is fundamentally healthy and continues to grow steadily.
That's an important point. So you're saying the market is focusing on the shrinking special items and ignoring the growing core business. Let's take a closer look at this core business. What exactly does Sonic do, and what makes its business model so robust?
At its core, Sonic's business model is strikingly simple and easy to understand. The company operates medical laboratories and radiology centers worldwide. Its customers are doctors, hospitals, and other healthcare providers who need diagnostic tests for their patients. From simple blood tests to highly complex genetic analyses. Sonic performs these tests and then bills them to health insurance companies, insurers, or directly to the patients. The robustness comes from several sources. First, demand is not cyclical. People get sick and need diagnoses, regardless of whether the economy is growing or shrinking. Second, Sonic benefits from unstoppable demographic megatrends. An aging global population simply requires more medical care and therefore more diagnostics. healthcare spending per capita increases exponentially with age. In addition, there is a rise in chronic diseases such as diabetes or cancer, which require constant monitoring. This leads to structural, long-term growth in the market.
But now, a short commercial break.
As a successful asset manager or trader, you know what makes an outstanding investment strategy. But how do you turn this expertise into your own scalable investment product without getting lost in regulatory details and high fixed costs? How do you make your strategy accessible and investable for a broader audience? The answer lies in a superior structure. Welcome to iMaps Capital Markets. We have created a platform that transforms your individual investment strategy into a fully regulated investment product. A professional, exchange-tradable, actively managed certificate, or AMC for short. This is listed on EUVAC Stuttgart, the world's largest exchange for investment products and AMCs. Your clients benefit from continuous trading from 9 a.m. to 5:30 p.m., German time, and professional market making, which ensures top-tier liquidity at all times. The decisive advantage for you? A significant cost advantage over traditional fund solutions and unmatched strategic freedom. Our structure guarantees you full retail marketing rights throughout Europe. And the best part? You operate free from rigid constraints. Diversification, leverage, and investment restrictions, such as those required for UCITS funds, do not apply. You implement your strategy. Authentic, agile, and without compromise. From legal structuring to ongoing administration, we manage the entire life cycle of your investment product so you can focus on what matters most, your clients and your performance. Discover the freedom to realize your visions without compromise. Book your strategic consultation today at imapscapital.com. iMaps Capital Markets. Your strategy. Our structure.
Welcome back to EquityStory.ai. That sounds like a very defensive business model with built-in tailwinds. But in such an attractive market, there must also be a lot of competition. What prevents others from taking market share from Sonic? Where is the famous economic moat?
Sonic's moat is wide, deep, and rests on several pillars. The first and most important one is the sheer size and the resulting economies of scale. Sonic is the third largest pathology provider in the world and the market leader in Australia, Germany, the UK, and Switzerland. This size gives them enormous purchasing power for equipment and reagents. They can optimize their logistics and spread the high fixed costs of state-of-the-art laboratories over a huge test volume. For a new, smaller provider, it's almost impossible to keep up with them on price. The second pillar is network effects. Sonic operates an extremely dense network of blood collection centers. For a doctor, convenience is crucial. If there's a Sonic center just around the corner, the doctor will send their patients there. More doctors using Sonic justify the opening of additional centers, which makes the network even denser and more attractive. A classic self-reinforcing cycle. Third, while not insurmountable, there are noticeable switching costs. Doctors and clinics are accustomed to the ordering systems, the report formats, and above all, the personal relationships. They are used to the local Sonic pathologists. Switching involves effort and risk.
You're talking about culture. That's often considered a soft factor. But at Sonic, it seems to play a special role.
Absolutely. And that is perhaps the hardest part of the moat to replicate. For decades, Sonic has pursued a philosophy of medical leadership. At the head of the company is Dr. Colin Goldschmidt, a trained pathologist who has been in charge since 1993, not just a financial manager. This culture permeates the entire company. The priorities are clearly defined. First the employees, then the service for doctors and patients. And only in third place come the financial results, based on the firm belief that profit will follow naturally if the first 2 points are excellent. This creates enormous trust among the core clientele, the doctors. This is coupled with a unique federal model. When Sonic acquires a laboratory, it is not simply shut down and centralized. On the contrary, the local management and the established brand usually remain in place. They can continue to respond to local needs, but benefit in the background from the group's global strength in procurement, IT, and best practices. This is the key to their extremely successful buy and build strategy, which they have been pursuing since the 1990s.
That's a fascinating insight into the company's software. Let's talk about the hardware now, meaning capital allocation. You mentioned the successful acquisition strategy. The management took in enormous amounts of money during the pandemic. What did they do with it?
They used it extremely wisely and with great discipline. Put it to use. First, they took advantage of the moment and massively deleveraged the balance sheet. Net debt was reduced from over 2.5 billion Australian dollars before the pandemic to under 900 million Australian dollars by mid-2023. With that, they have created a massive war chest for future growth. And this fund is now being used specifically for strategic acquisitions. Here, we are witnessing the groundwork being laid for the next phase of growth. The best example is the acquisition of the Lada Group in Germany for around 700 million Australian dollars. Lada was one of the top 5 players in Germany. With this acquisition, Sonic cements its undisputed number 1 position. Number 1 position in the largest and most important healthcare market in Europe.
That sounds strategically sensible. But I read that Eladere's margins are lower than Sonic's. That has concerned some analysts. Isn't that a risk?
That's an absolutely valid point and part of the current bear story. Yes, in the short term, this acquisition, like some others, is margin dilutive. But that's exactly the point where long-term investors need to think differently from short-term traders. Management isn't buying for the next quarter here, but for the next decade. They have a clear plan to realize synergies. In procurement, in logistics, in the shared use of specialized laboratories. The plan is for this acquisition to yield a return on capital, ROIC, of over 11% after 3 years. That's an excellent return on invested capital. You have to give management the time to unlock this value. Their track record of integrating over 40 companies in recent decades speaks for itself.
In addition to consolidation in Europe, Sonic has also made an interesting acquisition in the US, which is heading in a completely different direction. Pathology Watch. What's that all about?
For me, this is one of the most exciting aspects of the current strategy and a clear sign of how forward-thinking the management is. Pathology Watch is a US company specializing in digital pathology and artificial intelligence, or AI. Sonic has invested around $150 million here. Pathology is one of the last medical disciplines that still operates largely in an analog way, using physical tissue slides under a microscope. The future is digital. Tissue slides are scanned in high resolution and can then be assessed by pathologists anywhere in the world on a screen. AI algorithms can help by highlighting suspicious areas and drastically increasing both efficiency and accuracy. By acquiring Pathology Watch, Sonic is securing not only a leading technology platform, but also valuable data and algorithms. This is an investment that will massively widen the moat in the coming years by making the service faster, better, and more scalable. Again, the company is not yet profitable and will weigh on the balance sheet in the short term, but the strategic value is immense.
So, we have a robust core business, a wide moat, an experienced management team, and strategic acquisitions that secure the future. Let's put all of this together and look at the valuation. Charlie, after the share price drop, is the stock now cheap?
From my perspective as a value investor, yes. The valuation has become attractive. The price-earnings ratio, or PE ratio, based on the last 12 months is just under 20. At first glance, that doesn't look extremely cheap, but you have to keep in mind that it's based on the heavily depressed post-COVID earnings. A much more meaningful perspective is to look ahead. The expected P/E ratio for the coming year is about 17.5. For a global market leader in the defensive healthcare sector with the aforementioned quality characteristics, that's a very reasonable valuation. The enterprise value in relation to EBITDA is about 9, which is also fair. It gets even more interesting when you look at the analysts' forecasts. The average 12-month price target is around 28 Australian dollars. At the current price of about $21.20 Australian dollars, that corresponds to an upside potential of over 25%. And for income investors, the current dividend yield of almost 5% is also very attractive. Management has a clear, progressive dividend policy, and they have kept the payout stable even during the transition phase, which is a strong commitment to returning capital to shareholders.
That sounds convincing. But to get a complete picture, we also need to talk about the risks. No investment is without them. Where do you see the biggest risks to the bull case? What could go wrong?
Absolutely, that's essential. The biggest external risk is and remains the regulatory pressure on reimbursement rates. A large part of Sonic's revenue depends on government healthcare systems like Medicare in Australia or the public health insurers in Germany. Cuts to the fees paid for tests are a constant threat and would have a direct impact on margins. In the US, there were concerns about the so-called Palmer cuts, but these have been postponed for now, and in Europe, there have already been smaller fee reductions that have somewhat slowed growth. The second risk is the execution risk associated with acquisitions. I praise the strategic logic behind the Alada deal, but integrating such a large company is a Herculean task. If the promised synergies are not realized, or only more slowly than planned, the margin pressure will persist longer than the market expects. Patience is a virtue that value investors are known for. Charlie, to conclude, what, in your view, is the decisive catalyst that could trigger a revaluation of the stock? The decisive catalyst has already been communicated. The market just needs to internalize it. It is the official company forecast for the 2026 fiscal year. Management is projecting profit growth here, per share of up to 19%. This growth is fueled by three sources: solid organic growth of the core business, the first realized synergies from recent acquisitions, and the full-year contribution from the Eladra acquisition. As soon as the next quarterly or half-year reports show that the company is on track to meet this forecast, the market narrative will shift from declining profits to a return to double-digit growth. That is the moment when a revaluation is likely to take place.
A very clear and data-driven assessment. So let's summarize. Sonic Healthcare is a high-quality company with a strong moat and excellent management. The market has heavily sold the stock due to the expected and now realized normalization of COVID-related profits, and now values the company at a level that seems to ignore the strength of its core business and the future growth potential from recent strategic acquisitions. For long-term investors who can tune out the short-term noise, this could present an attractive opportunity. Charlie Goldstein, thank you very much for these deep insights and for your time.
It was my pleasure, Lilith. Thank you very much.
And to you, dear listeners, thank you for tuning in. We hope this analysis has provided you with valuable food for thought. Until the next episode of EquityStory.ai, take care.